Learning Objective 5 is analyzing PP&E, and we're going to look at 3 ways to analyze it. First is the turnover rate, second useful life, and percentage used up. Turnover rate, by the way, is the most common of these 3. We look at how productive is the company. When we look at sales, we look at sales divided by the average PP&E, and we say for every dollar of assets, we generate this amount of sales. So we want this number big, high, because the lower that number is, that means the less productive our PP&E is. If our asset base generates $100 per dollar of assets, that's a pretty good number compared to if it's only 10. This is a powerful and easily computed ratio called PPE turnover. Next, we look at how do we analyze it, is that we prefer it to be high. And what would that mean? Well, it means that we use less cash tied up in our fixed assets, and we can then have lower cash, therefore could have higher return on assets. Also, we can turn over our sales more quickly because we're able to utilize equipment and hopefully other assets more quickly and shorten the amount of time. PPE used up. If we use straight line depreciation and we have zero salvage, then we have average useful life computed as follows. What's the depreciable asset cost, that's the gross PP&E, divided by depreciation expense? And that gives us an idea of how long our assets are expected to take place. In the first example, the one we've been using, the depreciable asset cost was $100,000. The PP&E expense was 18. When we divide 100 by 18, we get a number of a little more than 5 years. So the average life of that asset is 5 years, or a little bit more than 500. If we did that across the entire asset base and not just on one machine, that is a good approximation. You take the gross PP&E divided by depreciation expense on a straight line basis, and you get an estimate of the useful life of all the assets in that company. Next is percentage used up, and same kind of calculation. We take the data, like in this case accumulated depreciation, like that's all the depreciation we were ever provided for, divided by the asset cost. And when we divide the accumulated by the asset cost, it gives us a percentage. What percent of the asset cost have we already depreciated? So again, using the machine as an example, if it's $100 cost and it's $18 of accumulated depreciation, it's 18 divided by 100, which means pretty small. We've only used up 18% of that asset. Again, simple calculation using big numbers to give us a broad indicator of how used up, in this case, the assets are. If that accumulated depreciation later in its life is, say, $80,000, 80 divided by 100 would be 80%, which means we've used up most of our equipment. Analysis is, it gives us some feel for the age of the equipment, and if it's too high, like that 80% I mentioned, then we would anticipate that they're going to have to retool their business, and we're going to see high capital expenditures in the future. So that's a warning sign. Summarizing this chapter, we looked at inventory costing methods of FIFO, LIFO, and average costs, and saw how that yields different values for cost of goods sold and inventory. We looked at how that relates to the cash conversion cycle, and also looked at gross margin as a measure that's directly affected by inventory costing methods. Third, we looked at tangible assets, specifically depreciation, and looked at the most common methods of depreciation, which is straight line, but also an accelerated method by way of comparison, double declining balance. Fourth, we looked at asset sales, asset impairments, and also restructuring. And these are fairly common things that occur in companies, so you should be cognizant of what gives rise to these entries and these fairly large dollar amounts. And finally, we looked at some measures on how to evaluate PP&E. We looked at PP&E turnover, and then we looked at the PPE useful life, and finally, the percentage of the assets used up. That's chapter 6. Next, we'll move on to chapter 9, which is on intercorporate investments. Thank you.